Welcome back to ACC 120 Financial Accounting. Today we're going to look at Chapter 10, which covers stockholders' equity. Now, this is the accounting equation. We've seen this many times before, and we know that assets equal liabilities plus stockholders' equity. There's some primary components of stockholders' equity. One is paid-in capital. This is the amount stockholders have invested in the company. Two is retained earnings. This is the amount of earnings the company has kept or retained. That is, the earnings not distributed in dividends to stockholders over the life of the company. And three, we have treasury stock. This is the company's own stock that was issued before and it has repurchased. Here's an example of an organizational chart. Stockholders are the main owners of a company. They choose the board of directors, and the board of directors appoints the chief executive officer or CEO. Below the CEO, you're going to have pretty much everybody else in the company. You've got the vice president of management, vice president of marketing, chief financial officer, legal counsel, vice president of human resources. There might also be other positions like COO and so on. Let's look at stages of equity financing. Corporations first raise money from founders of the business, friends, and family. To grow, companies are going to seek investments from angel investors. These are wealthy investors like those that are featured on the TV show Shark Tank. And venture capital firms, they provide additional funding and business expertise. And then they've got the IPO, or initial public offering. This is the first time a corporation issues stock to the general public. So let's look at the difference between public and private corporations. Public corporations allow public investment. Private corporations do not allow public investment. Public corporations have more stockholders, where private corporations have fewer. Public corporations are regulated by the SEC. Private corporations, on the other hand, are not regulated by the SEC. Examples of public companies are going to be Walmart, Microsoft, or Intel. Examples of private corporations might be Cargill, which is an agricultural commodity, Koch Industries, which is oil and gas, and Mars, which is food and candy. Let's look at some of the rights of stockholders. Stockholders have the right to vote. They vote on matters, including the election of corporate directors. They also have the right to receive dividends. Stockholders share in profits when the company declares dividends. The percentage of shares a stockholder owns determines his or her share of the dividends distributed. They also have a right to share in the distribution of assets. Stockholders share in the distribution of assets if the company is dissolved. The percentage of shares a stockholder owns determines his or her share in the assets, which are distributed after creditors and preferred stockholders are paid.